This is the Asia Trade. I'm Shery in Tokyo.
I'm Avril, Huang in Singapore. The top stories this hour. A cautious open for Asia in a busy week for earnings, central banks and economic data. Oil in focus with OPEC Plus set to pause further output increases next year. Westpac delivers full-year profit in line with estimates helped by growth in mortgages and loans to businesses. Also ahead, New Zealand Prime Minister Christopher Luxon speaks to Bloomberg about the challenges of a changing global trade order. Plus, we're live at Hong Kong FinTech Week, speaking exclusively to the city's Financial Services Secretary Christopher Hui.
And with daylight savings time ending in the United States, you're seeing U.S. futures coming online, a little bit of upside after gains last week. And remember, the S&P 500 has gained about 18% since President Trump's election. But it's really been about that economic expectations of Fed rate cuts, not to mention the artificial intelligence boom. So if you take out those mega cap tech stocks, then you get only gains of about 5% for the S&P 500. Still, the optimism is there. We are expecting really that focus on the trade deals that we got out of the APEC in South Korea over the weekend as well. Not to mention, of course, that we're watching the dollar continue to rally about 3 sessions right now and the best second best month of the year already. We saw Treasuries also under pressure, really finishing that winning streak that we saw the longest since March. We continue to get expectations that perhaps the Fed was a little bit more hawkish than expected in its previous meeting. So we're seeing the 10-year yield now surpassing that 4% level. Now, the U.S. government continues to stay shut for a 5th consecutive week. So right now, this week, we're expecting payrolls numbers and the job openings numbers, which will not come until the U.S. government opens again. We're watching oil prices at the moment, Brent gaining 0.5%. And of course, we continue to follow the OPEC Plus negotiations, which over the weekend agreed to pause output hikes in the first quarter, which is a modest increase for next month, Avril.
Yeah, Shery, we'll be watching those oil-related names in the session, including in Australia, along with some of the banking-related counters, including Westpac. But on top of that, gold-related stocks in the Asia-Pacific, following on from China ending tax breaks. What might this mean for the retail frenzy? Now, on top of that, we also had over the weekend data out of Australia showing housing prices climb at the fastest monthly pace in about 2 years. So does this feed in to the equation for an RBA that is set to stay on hold? Of course, that meeting and the decision that's due tomorrow. You talked about the greenback and how it has been performing quite well so far. Of course, the other side of the equation on that is the Japanese currency, worst performing G10 so far this year. And of course, we also have data in the form of a private gauge of China's October PMIs. That is due today, expected to show only a moderate expansion in factory activity due mainly to a national holiday. We'll get official October trade data for China on Friday. Export growth probably slowing as trade with the U.S. worsened. Economists surveyed by Bloomberg unanimously expect Australia's central bank to keep interest rates at 3.6% at its meeting on Tuesday. And this comes after consumer prices surged above expectations. Malaysia, meantime, expected to keep policy steady when it announces its rate decision on Thursday, amid stable growth and benign price pressures. Let's bring in Deepali Bhargava, ING's head of research and chief economist for APEC. Good to see you, Deepali. So one thing I guess we're still unpacking, following on from the trade truce, the impact on the Chinese economy. Obviously, the data points this week won't reflect that. But what is your sense of what we've been seeing so far and how that feeds into the case for more stimulus from policymakers?
Correct. I think what the trade truce, and we have to really remember this is a truce. This is really not a pact, but what it does is it really de-escalates the immediate need to, really ramp up tariff and non-tariff measures. So it's great news for the markets. It removes a bit of uncertainty that has been in the markets for a while now. So I would imagine the sentiment to go back to the September levels because of this truce. But remember, this may not necessarily be the case for the longer term. So for this truce to hold a lot of things need to go right. I think what we've effectively done is this truce, which was being held for 3 months, has now been extended to an year now. But for all of these things to fall in place, a lot of things need to go right in that 1 year for this truce between US and China to hold. And secondly, don't forget, this may not necessarily call for a structural improvement in trade relationships, or so to say, moving towards a globalization. China has been working towards really de-risking China and going in for economic security by doing various stuff like, diversifying exports, for example, or diversifying its FX reserve composition. So I think all of these longer-term themes are still pretty much intact.
What about the extent in which this means more stimulus from Chinese policymakers, especially when the property sector is still doing fairly badly?
Right. So we do expect some of that stimulus to come through. And I think some of the recent numbers that we've seen from the property market sector do suggest that the property market could be bottoming out. But for it to really pick up and be the engine of growth the way it was previously, I think it's a bit unlikely. I think China is finding new drivers of growth in green energy, in technology, and that should really take over as a new driver of growth.
Are those the sectors that we'll be watching in the equity space as well when the markets, we are setting up for investors watching the markets? Are those good hedges to bet on the Chinese economy?
I would think so. I would think that so far the data that we've seen has actually beaten market expectations. Our 2025 Chinese growth outlook was always a bit upbeat, even though, for example, you've seen a bit of a data disappointment. So the recent PMI numbers, for example, that you saw for China were disappointing. New export orders at a 6-month low. But for all of that to get translated into hard data is something we've not seen as much. So I think with this truce coming in between US and China, I think we really need to see if this means there is a consolidation in exports, because overall at the margin, I think what's really holding up China growth has been exports and industrial activity. And with this truce coming through, I think China benefits, because now your tariff differential between China and the rest of Asia has narrowed down, so that entire talks of China re-exporting through other economies will kind of come off, and overall China should be a beneficiary at the margin.
We are also seeing incredible optimism about the Japanese economy, given, of course, the trade deal that was struck with the United States. But at the same time, the Bank of Japan seems to have its hands tied when it comes to the next rate hike. What are your expectations, especially on the week when we're getting the wage data as well?
Right. So we do expect wage growth to remain strong in Japan, about 2% year on year. I think some of the data indications have been pointing towards that. The labor negotiations which have just happened have been pointing in a strong wage growth direction. And I think the larger corporates have been able to give those kind of wage hikes, which perhaps the smaller and medium scale enterprises have not been able to, just because everybody wants to secure labor, which is not very abundant in Japan. So wage growth is going higher, and we think that will continue to be the case. And while it's difficult to say eventually how quickly BOJ hikes, but I think for now we're sticking with a hike in December.
What sort of assumptions are you making about the US dollar and the potential impact for Asia economies?
Right. So I think we've been of the view that a US dollar will weaken in the fourth quarter, and primarily coming from the fact that we continue to expect one more rate cut in December. So I think what people, and perhaps what the market after the recent Fed move have been missing out is the inflationary pressures may not actually be as acute as you might imagine confusion with this whole tariff story. So obviously tariff is one part of it, but the number of goods within the CPI basket that get impacted by tariffs is just 20%. So if you look at the rest of the 80% of the economy, what you're seeing is energy prices are weaker, wage growth is weaker because labor market is weaker, and then the housing sector is weakening as well. So we think these factors will outweigh the impact of tariff, and hence we do think that will play out on the Fed for December, and hence on the dollar in the form of a weaker dollar.
Deepali Bhargava, really good to have you with us, Chief APAC Economist at ING. Let's actually delve into the U.S. markets and the Fed's next moves, because they've become a little bit more uncertain after Chair Jay Powell said a cut in December is far from a done deal. The divergence in views among Fed officials is also becoming more pronounced. Let's get to Garfield Reynolds, who leads our Markets Live Asia coverage. Garf, so we are seeing the divergence in views. We're also seeing the divergence when it comes to the stock market, just continuing to rally with the lack of economic data given the ongoing U.S. government shutdown. And let's not forget that it's a fifth week already. What will you be watching for direction?
Well, one of the big things that we're watching for direction is that we're supposed to get the Supreme Court considering the tariff case. So that's got the potential to bring some major volatility. Or if they back President Trump and so tariffs stay where they are and the market seems pretty comfortable, as it were, with tariffs as they are now enacted, then that would add that extra bit of certainty about what's happening, and that would be taken as a positive for equities. Otherwise, very much keeping an eye on the idea that the AI boom is going to keep going, and in particular, while there were some stocks that suffered when their particular companies reported things that investors were concerned about. I'm thinking mostly about Meta Platforms there. The overall picture of still extremely strong demand for AI and therefore extremely strong capex from the so-called hyperscalers like Amazon and Google, that just helps to keep the bid going under stocks, not just US stocks. We've seen a lot of Asian markets that are benefiting from that. So those are the two things that we'll be watching most closely this week.
And we're also seeing strength in the U.S. dollar, right? What a reversal from one of the weakest summers in years. But this is also putting pressure on the other side of that trade, with Asian currencies under pressure. The yen, 154.
Yeah, the yen has had a wild run over the last few months, and that's not likely to stop being the case amongst the concerns. So in many ways, the yen, maybe about where it is now, is something that the government and certainly equity investors would welcome because it helps Japanese exporters. But if it gets much weaker from here, there's a couple of things that start to come into play. One is you might get some backlash at home because the Japanese are used to having a strong yen, so not being able to go on holidays so cheaply as they used to, and also the increased cost of imported goods. So that would make the government uncomfortable. There also might be some concerns that the Trump administration wouldn't like to see the yen this week. So if it gets much weaker, we're going to start to see jawboning from Japanese officials and a reminder that they could intervene to try and prop up the yen if it gets much past 155.
Garf, the other asset, I guess, that we're seeing a bit of weakness is in gold after, perhaps because China ended these tax breaks on the precious metal. Then you have the US-China trade truce. What are you seeing in terms of drivers, and does that drive things much further below the 4K handle?
I doubt it would drive it too much further below, because the overall dynamics, which are arguing for a stronger gold price over the longer term, the diversification from central banks, the overall, the FOMO when it comes to gold is that there's a need for the sort of the ultimate hedge is what it's been seen as. But in the short term, this is a reminder that there are reasons for there to be weaker retail demand from China and from elsewhere. So you could see a little bit of a step down from here, but you've got a lot of investors and a lot of analysts who are forecasting that gold will go back above 4,500 over the coming year. That seems like a fair call. If you look at it over the longer term, we had this incredible explosion last month. That was always likely to lead to a retreat, but the drivers for higher prices for gold over the medium to long term are still very strong.
And some see 5K in its sights. Garth, always great to get your insights. Thank you so much. Garfield Reynolds leads our MLive Asia coverage. Also coming up on the Asia trade, Capital Economics weighs in on the outlook for the yen and BOJ policy, and we'll be live at Hong Kong FinTech Week for an exclusive interview with the city's Financial Services Secretary Christopher Hui. Much more ahead. This is Bloomberg.
The White House says China will effectively suspend implementation of additional export controls on rare earth metals and terminate investigations targeting U.S. companies in the semiconductor supply chain. But Treasury Secretary Scott Bessent cautions that allies still need to be wary.
The Chinese have cornered the market, and unfortunately, at times, they prove to be unreliable partners. I think, and I hope, after the agreement and the goodwill between President Xi and President Trump in Korea, that we can depend on them to be more reliable partners, and the rest of the world can depend on them. But we can't take that chance. We don't want to decouple with China, but we're going to have to de-risk.
Let's bring in our China correspondent, Mimi Lo, in Hong Kong. And of course, Mimi, we saw the positive sentiment after the Trump-Xi meeting on the sidelines of APEC. But at the same time, we have seen this play out, right, where there's optimism and then no follow through. So could we expect some more details to come through?
Yes, we are getting some details from the U.S. side. The White House had released a fact sheet on exactly what was agreed upon. Bear in mind, the Chinese side has not really elaborated on this. So this is all according to the White House. China has agreed to suspend export controls, undoing the measures that were imposed not just in October this year, but also in April this year and in October 2022. This means that general licenses would be issued for rare earths, for antimony, for graphite, for the likes of gallium and germanium as well. And this is obviously a very big win for the United States. The White House saying that this is a massive victory for U.S. national security. And you can see on the screen as well that the Chinese actions also include actions to stem the flow of fentanyl, to buy a certain amount of soybeans, 12 million metric tons to be exact this year, and 25 million metric tons for the next 3 years. China also agreed to suspend the countermeasures, including tariffs and non-tariff measures since March 4, and that includes all those agricultural tariffs on U.S. goods, and also suspending investigations, antitrust, anti-dumping investigations into U.S. chips companies, the likes of Nvidia, Qualcomm, and also facilitating the resumption of shipments from the Chinese unit of Nexperia. That's the Dutch chip firm that was seized by the Dutch government. But here is where we are seeing a little bit of divergence. The Chinese Commerce Ministry releasing a statement saying that it was the Dutch government's inappropriate intervention in that company that caused the chaos in the supply chain, and that China will assess the situation and pause those export controls accordingly.
Min, it's sometimes hard to keep tabs on these developments between the U.S. and China. Thanks for getting us across all these lines. Bloomberg China correspondent Min Lo. In the meantime, New Zealand Prime Minister Christopher Luxon says his country remains committed to reaffirming ties with allies amid rising risk to the global trading order. He spoke to us on the sidelines of the APEC Leader Summit in Gyeongju, South Korea.
think there's three big shifts that are happening. We're seeing a shift from sort of rules to power. We're seeing very much a strong connection between economics and security. And the third thing we're seeing is a lot more national resilience rather than globally connected supply chains. And that's a function of COVID, it's a function of our economics, a function of a changed trading environment. So there's no doubt about it, the rules-based system that has served us well for 70 to 80 years is challenged. But within that context, we should be incredibly optimistic that we can plot a course and that we can innovate and that we can incubate new ideas as we have done in the past out of APEC. And so whether it's been the FITP, whether it's been the thing that both Mark and I have advocated very strongly for and talked to the Europeans about, is to have an EU CPTPP dialogue, a trade dialogue, so that we can reaffirm the rules-based system. Those are important things. But equally, we should be reforming the WTO. We should be doing a bunch of things to make sure that we are relevant and on point and able to deal with the world as it is today.
And Mark Carney's strategy is to pivot to Asia from the US, because the US is a much less reliable trading partner for Canada than it has been in the past. New Zealand's obviously very, very dependent already on trade with Asia. Do you have a similar strategy of sort of trying to improve and increase New Zealand's trade?
Our strategy is pretty simple. As a small trading nation, as we want to do business with as many people as possible and as many places as possible. And so our real focus as a new government has been an Indo-Pacific reset and focus. We see that's where our security sits, that's where our prosperity will sit. That's why we've had over 42 visits, I think, into Southeast Asia alone as a government. But we spent a lot of time in China, in Southeast Asia, in Northeast Asia, expanding our FTA, negotiations with India, obviously closing out negotiations with GCC and the UAE, building back a strong relationship with Australia and having and playing a role in the Pacific. So, for us, our Indo-Pacific region is both where prosperity and security sits, and both those two things in 2025 are inextricably linked. You can't have one without the other. They are mutually dependent on each other.
And on the domestic economy, the economy contracted in the second quarter after a number of consecutive contractions. Reserve Bank cut rates in October, but Nicola Willis was telling us last month that she's confident the economy is growing this quarter. Are you as confident at the start of November that the economy will return to growth in the fourth quarter? Are rates where they need to be accommodative enough for New Zealand, and what can you do on the fiscal side to help the economy sort of return to growth?
Yeah, look, we're coming out of a recession that's been our biggest recession, I think, in 35 years. New Zealand also had probably one of the longest COVID hangovers. We were the second biggest proportionately spending economy. The previous administration, was a big spending government, taxing more, borrowing more, spending more. Our job is to put the fiscal repair and consolidation in place, and that's what we've been doing. And so I think as fiscal partners, getting control of spending so that we can get inflation down, get interest rates down, get the economy growing, and lower unemployment is a good thing. And we're well on that pathway. We had good growth in Q4, good growth in Q1. Obviously, the second day of April with Liberation Day, that meant a huge loss of confidence to investors and also to consumers. But we're growing again in the third quarter and expected to accelerate in the fourth quarter. The outlook for New Zealand is very positive. I mean, we are expected to grow 240,000 new jobs in the next 4 years, average probably 2.7% growth, I think 2.4 over the next 2 years as well. So, the outlook is there, but the question now is we don't just want to watch a recovery take place, we want to shape that recovery. And that means for us, we've got a fantastic future, we've got a great country, and we need to make sure it realises all of its potential, and that's what my government's very focused on.
So the Reserve Bank said at the meeting, or the governor said that the economy is still weak and they were looking to cut further. You probably won't comment. If you're happy to comment on where the policy rate should be, I'd love to hear that. But I mean, do you agree with that?
Well, I respect the independence of our Reserve Bank of New Zealand, but they've already forecasted that they've got one more opportunity potentially to cut rates further before Christmas. And again, what you need is fiscal and monetary policy working in concert together. And so we're doing everything we can as a government to make sure that we're getting rid of the wasteful spending, that we're actually doing our role, so that coupled with monetary policy, we can actually lower inflation, lower interest rates.
New Zealand Prime Minister Christopher Luxon speaking with Bloomberg's James Maker. And here are some of the other top global headlines that we're following. President Trump has threatened possible U.S. military action against Islamist militants in Nigeria unless the country's government halts the killing of Christians. Trump designated Nigeria as a country of particular concern, and in a Truth Social post also threatened an immediate cutoff of aid. Nigerian President Bola Ahmed Tinubu rejected Trump's claims that his country is religiously intolerant. Energy Secretary Chris Wright says the U.S. nuclear weapons testing ordered by President Trump will stop short of actual warhead tests for now. Wright told Fox News he believes what's being discussed are system tests involving other parts of the weapon and without nuclear explosions. Trump said last week he's ordering the Pentagon to start testing nuclear weapons in response to other nations' programs. U.S. Defense Secretary Pete Hegseth has called on Southeast Asian nations to strengthen cooperation and counter Chinese aggression in the South China Sea. Speaking at a meeting of ASEAN defense ministers in Malaysia, Hegseth urged the group to develop joint capabilities to address threats. He also raised concerns about China's naval activity around Taiwan during a meeting with his Chinese counterpart, Dong Jun.
China's behavior toward its neighbors and the world is a wake-up call, which it is. Share examples of intimidation, harassment, and illegal activities occurring within your sovereign waters and across the South China Sea. Unfortunately, in the months since then, China's destabilizing actions have only increased.
We have more ahead on the Asia trade. Stay with us. This is Bloomberg. Take a look at how we're trading early in the Asia session. You're seeing U.S. futures to the upside of 0.2% after we already saw a rally last week. Remember, we're seeing expectations of an economic recovery with big tech stocks fueling those gains with artificial intelligence themes. And you see Kiwi stocks, though, early in the Asia session down 0.2%, but falling after 6 sessions of gains already. The ASX 200 also under pressure. We're expecting the RBA rate decision this week. The expectation is for a hold. One stock that we're watching is Westpac and trading in Australia after the bank's full-year net income slipped about 1%, which was in line with expectations. Bloomberg's Paul Allen joins us now with more on this. And Paul, what were some of the key takeaways from these results?
Yeah, not a bad set of numbers from Westpac. Certainly the dividend, $1.53 per share, up 2 cents on last year. That'll be good news for investors. The net income, though, that headline number, 6.9 billion Australian dollars. That's about 4.5 billion US. It did slip a little bit, as you mentioned there, but in line with estimates. Now, it's worth mentioning, you said the RBA there has got a meeting tomorrow. We've seen 3 RBA cuts during the past fiscal year for Westpac, although after this week's hot quarterly inflation prints, the path for future cuts could be in doubt. We'll touch on that in a minute. But costs have also been a focus for Westpac. The new CEO, Anthony Miller's been cutting jobs. Westpac's also sold its Rams mortgage lending business for about $21 billion. That should streamline the business as well. And there's been a lot of investment in updating the technology at Westpac also to the tune of getting on for 2 billion Aussie dollars as well. So a few changes going on under the hood at Westpac.
Under the hood, also, if the RBA is cognizant of these housing price data, I mean, that was partially why we saw a higher than expected inflation print. And then over the weekend, monthly, those prices gaining by the most since, I think, 2 years. What is this going to mean for the outlook for Westpac?
Yeah, absolutely. The fastest pace of house price gains in 2 years in Australia, as you say, and prices have already been in nosebleed territory for some time. They just keep on going up. And there's a bunch of factors behind this. There's the often talked about supply squeeze. There have also been changes. First home buyers now only need a 5% deposit to get into their first home, and lower interest rates as well has really been driving property prices forward. So the median house price in Sydney now, 1.6 million Australian dollars. That's about $1 million US, but we've seen strongest gains in Perth, Brisbane and Darwin as well, so some of those smaller capitals. So that would suggest, okay, you're probably going to get stronger lending ahead for the big banks, including Westpac, but at the same time, going to be a lot more intense competition for that lending. It's going to mean pressure on margins, and we saw the net interest margin for Westpac just slipping 1 basis point in the past year to 1.94%. Now, that RBA decision we're getting tomorrow, scenario, we are expecting to see a hold. I mentioned that third quarter inflation data was pretty hot, so it reinforces the case that nothing's going to happen. Westpac's revisiting its forecast for cash rates, but other banks have already been out with their forecast. Commonwealth, for example, thinks the rate cutting cycle is done. That may or may not put a lid on property prices, but yeah, it doesn't get away from this ongoing supply problem in Australia.
Paul, thank you so much, marrying the macro with these banks' outlook for us. Paul Allen in Sydney. Now, Berkshire Hathaway's cash pile soared to a record $382 billion in the third quarter. Corporate filings show operating earnings surged 34% to almost $140 billion. Let's bring in Bloomberg's Berkshire reporter Alexandra Rajbandari in New York. Alex, tell us more about this record cash hoard.
Yeah, indeed, it's a record for Berkshire Hathaway, $382 billion. What happened is Buffett decided not to really invest massively in shares this quarter. It's been the case for some time now. So he sold $6.1 billion in equities over the period. And he didn't buy back any of Berkshire Hathaway's shares. It's been more than a year now that investors have not gotten their shares bought back. So, this raises a lot of questions for investors. And I was talking to an analyst yesterday when the earnings hit the wires. If Berkshire has that much money and decides not to buy their own shares, why should they?
You mentioned, we saw earnings really surging, right? More than 30%. And at the same time, we do watch Berkshire's results because they sort of reflect the health of the U.S. economy. Can we gauge anything from it? And what drove the operating earnings rally?
So the operating earnings surge was driven by the insurance department. Their underwriting results have more than tripled over the last year. This is mostly because this quarter was relatively quiet in terms of natural catastrophes. Remember, Melissa happened, but it was not in the U.S. and it was in the fourth quarter. And we haven't seen a big hurricane hitting the U.S. in that period. So that's been helping the insurance department. Although at Geico, there's been some expenses for underwriting, and that's mostly related to advertising. For the rest of the business, look, earnings are a bit higher up at BNSF, the railroad operator. They're a bit lower down at BHE. There's not much really we can take away from that. And that's actually kind of troubling for some analysts and maybe for some investors tomorrow. Again, the analyst I was speaking to yesterday told me, she was struggling to find some kind of catalyst for the stock price to go up.
So what are you watching in terms of what's next for Berkshire then?
Well, Warren Buffett has announced last year that he was stepping down from his role as CEO. So Greg Abel, his successor, is going to take over next year. To be honest, there's not much we know now about the changes that Abel will be willing to make, if he's willing to make any. But there are a few things that are emerging. We know that Warren Buffett is not going to be the one writing the annual letter for the next earnings that's going to be in February. This letter's it's a must read for all Berkshire watchers and investors because it's a lot of investment advices and also a lot of witticisms that kind of created Buffett's aura. So that's going to be changing. And also next year at the annual meeting in Omaha, Abel is going to be taking the Q&A. Buffett will not be doing that anymore. So we know a few things are going to change, even if Buffett is still going to be in the picture, is going to be chairman. But for the rest, I'm afraid we're going to have to be a bit more patient to know exactly what's going to happen.
Bloomberg's Berkshire reporter Alexander Rajbandari there joining us from New York. We have more ahead on the Asia trade. This is Bloomberg. We continue to see yen weakness against the U.S. dollar past that 154 level per dollar. It was around that 8-month low after the Bank of Japan left interest rates unchanged on Thursday. It's the worst performing G10 currency this year. It gained a little bit after we heard from the finance minister Katayama saying that the government is monitoring the yen, but those gains have not been sustained. Let's discuss a little bit more about the Japanese yen and the broader Japanese economy and bring in Abhijit, Surya, senior APAC economist at Capital Economics. Abhijit, good to have you with us. I mean, last week we heard from the former BOJ Governor Kuroda saying that the yen should be at around 120, 130. Is the weakness right now reflecting fundamentals?
So our view is that essentially, as things stand, interest rate differentials do warrant some weakness in the yen, but in real effective terms, it's already undervalued overall. So I think there is definitely scope for the yen to appreciate, but that is also contingent on the rates outlook at the end of the day.
Tell us a little bit about the rate differentials and what's really driving this yen weakness, especially given that we are supposed to be on a normalizing trend for the BOJ.
Yeah, I think there was hope that the BOJ would resume its tightening cycle, but that has been pushed out time and again. So for just a few weeks ago, the consensus was that we could see a rate hike. We would have seen a rate hike in October itself, but obviously that has not come to pass. And again, I guess the political uncertainty is sort of added to the flux. But overall, the picture is that markets don't see the next rate hike coming until well into early next year. And the BOJ itself, based on its latest communiques, at least, it doesn't seem in a hurry to rush policy normalization. So because of that persistent hesitance to resume tightening, I think that's sort of weighing on the yen and likely to do so. But our view is still that the Bank of Japan will resume tightening sooner rather than later, and we think it will actually end up hiking rates further than markets are currently pricing in. So we're forecasting a terminal rate of 1.5% at the end of the cycle.
Yeah, talk to us about that, because I think your view is that the BOJ's expectations of inflation, which it sees cooling next year, it's hard to marry that after those hot Tokyo CPI numbers.
Yeah, exactly. The Tokyo CPI definitely surprised on the upside, and it's something that I'm sure that the BOJ will be watching closely. Now, if you look at the BOJ's latest outlook report, it continues to argue that GDP growth will be modest, wage growth will slow, and underlying inflation will be sluggish. But again, that doesn't comport with the latest data we've seen. And in this press conference, Governor Ueda sort of acknowledged that there is some strength in inflation, but that in his view it largely reflects temporary supply side disruptions. Now, that may be the case for some CPI components like, say, rice inflation. But even as we saw from the Tokyo CPI data last week, even that isn't exactly falling off a cliff. And more importantly, our analysis finds that rising labor costs are playing an increasingly important role in driving up processed food inflation in particular, but inflation overall. So our sense is that once the BOJ has more confidence, has more information rather on the outlook for wages, it'll probably feel a little more comfortable. It'll move closer towards resuming its tightening cycle. So as it did earlier this year, it'll probably wait to gather more information about the upcoming Shunto spring wage negotiations before it makes that move.
The thing is, it does look like the BOJ does have enough data to pull the trigger, and its considerations perhaps centered more on domestic economic policy and the politics of the day. I wonder, as you pass the data, what are you seeing? What else are you seeing in terms of the labor market, perhaps in terms of participation rate as well?
Sure. So in terms of the labor market, the participation rate is obviously at a record high, and all signs would suggest that the labor market is tied by historical standards. Companies report strong labor shortages, and it would seem that the conditions are in place, ideally, for the BOJ to resume tightening. The labor market in and of itself should not be an impediment to that. I mean, to be fair, if you look at the data from the Ministry of Labor, earnings growth has sort of stalled at around 2% in recent months, so it's below the high of around 2.5% we saw in the second half of last year. So maybe that could be a factor weighing on the BOJ, but at the end of the day, I think once the BOJ, it puts a lot of emphasis on the shunto. So once it gets a confirmation that we'll get another solid pay increase in the upcoming shunto, it should be more comfortable with pulling the trigger. Because like you said, all the other conditions are in place. The economy, despite maybe some weakness in Q3, it seems to be growing above trend, and underlying inflation is on track to overshoot the bank's forecast. Yeah, sorry.
Just quickly, what about the confirmation that we finally have a trade deal with the U.S. and that uncertainty seems to have been taken off the table?
Yeah, you would think that would be a development that would support a resumption of policy normalization, but the BOJ, as always, is very cautious, and Ueda has said that the impact on profitability and wages could play out over time. So again, they will move slowly, but I think they will still end up moving sooner rather than later.
Abhijit, nice to see you. Thanks so much for running us through everything top of minds for economists looking at Japan. Abhijit Surya is Senior APEC Economist at Capital Economics. Catch Japan Ahead every Monday at 8:40 a.m. if you're watching in Tokyo, and subscribers can watch live on the terminal using the TV Go function. This is Bloomberg. Now, let's take a look at how Kospi futures are faring. Of course, we are seeing that handover from the U.S. and in terms of U.S. futures advancing also in early trade. So does that give us some sense that the 7 straight months of gains in global markets may have more room to run? We are also keeping tabs on some of the data out of South Korea. We did see exports gaining ground. And of course, the chip sector is in focus. This is a sector that has been driving the South Korean benchmark's gains. Also against the backdrop of China and South Korea leaders discussing cultural ties. This comes a decade after a ban. So lots to unpack here. For more on how South Korean markets are shaping up, let's bring in our stocks reporter, Yu Kyung Lee. Yu Kyung, we've just run through a number of perhaps investor focal points, but what do you think investors will be focused on when Korean markets open today?
Yeah, so when the regular market opens today, I think the K-pop stuff will be absolutely in investor focus today. Already in pre-market, we are seeing JYP Entertainment up about 9% in the pre-market, and other K-pop stuff such as HYBE, SM Entertainment, YG Entertainment, all rising already. And that comes after the National Security Advisor of South Korea briefing reporters that Xi Jinping and President Lee Jae-myung of South Korea have discussed some expanding cultural cooperation, cultural exchanges between the two nations. Now, the fact that this has been discussed during their bilateral summit is a real positive because, as you just mentioned, about a decade ago, China has imposed unofficial ban on South Korean entertainment and K-pop. So we have not seen any K-pop concert in the mainland for the past decade. And if the K-pop concert can resume with this lifting of the unofficial ban that Beijing has imposed about 10 years ago, that would be a huge boost to the earnings of the K-pop companies. China is an important market, but they've been missing out holding any concerts. So I think investors will be focused on the progress of how these cultural exchanges between the two nations going forward. So K-pop stuff will definitely be in focus for investors this morning.
And there's been a lot of positive news out of the APEC summits, right, including that deal that was finalized with the U.S. So not surprising, the Kospi new record highs. But we're talking about, what, almost 70% gains for the Kospi this year. How sustainable is this?
Yeah, it's incredible. And that question has been asked last week when I was meeting some analysts. Everybody was asking about where this Kospi is going and whether this gain is sustainable. But you have to think that at the start of the year, Kospi was just really cheap. So even at this level, after 70% gain at record high, Kospi is not that expensive if you look at the price to earnings ratio, which is around 13. And that's significantly lower than peers such as Taiwan and definitely lower than the S&P 500 or US stock market. So we have some analysts already saying that Kospi could run up until 5,000. That's JP Morgan and also local brokerage KB Securities. So there is a lot of optimism that the Kospi has more room to go. There's more leg to this rally. So while this week we might see some consolidation in the stock market and some investor might be looking for the rotational move in stocks that have not gained as significantly, we still, in the longer term to midterm, I think there's definitely more room to go for Kospi. And we are also hearing that retail investors are beginning to have more attention on the local stock market, which will provide more floor to the Kospi.
Yu-Kyung, you were alluding to some of this earlier about how chips have been driving or underpinning the gains in the Kospi. I just wonder, out of last week, against the geopolitical backdrop and what we are hearing from the likes of Nvidia, China sales, how do you assess the trajectory for some of these chip-related stocks in South Korea?
Yeah, I think that's an absolutely important question for anybody looking at the South Korean market or even Asian market. Chip stocks, they account for a huge part of Asia and also South Korea, about 30% of the market weight. And I think one thing to look at this week is that the October export data, which showed a significant gain in export, and that's been driven by the semiconductor sales in October. Even though there has been a long holiday during October, it still posted about more than 20% gains in exports, and that helped outweigh a fall in export in products such as auto, steel, and petrochemicals. So that already shows that the chip company is set to post a pretty strong earnings for the fourth quarter, and that has been already flagged by the chip makers Samsung and SK Hynix during their earnings report last week, which after reporting blowout quarters, they said their earnings are set to increase, and there's going to be supply shortages going forward, and there's going to be price gains. So all this point to a strong season for chip makers and chip stocks. So investors will definitely be really interested in, and they probably wouldn't be willing to sell anytime soon.
Bloomberg Stocks reporter Yu-Kyung Lee there with what to expect in the South Korean market that, as she mentioned, has been on a tear. We're talking about 68% gains this year already, and those semiconductors really fueling that rally. Memory chip shipments rising 25.4% just in October. Take a look at other markets, with U.S. futures now gaining 0.3% after a rally that has sent the S&P 500 18% higher since President Trump's inauguration. But you take away the mega cap tech stocks and you're seeing the S&P 500 only rising 5%. The ASX 200 in Australia down 0.5% in early trading. Avril?
Yeah, and this is, of course, despite this U.S.-China trade truce that's ongoing and perhaps also eroding some of the demand for the precious metal. 0.5% down, of course. The other element to consider is how China is ending its tax breaks for the precious metal. So that might affect some of the retail frenzy that has been driving gains in gold. Of course, along with other commodities that we're watching, it's the likes of crude, because we've heard from OPEC Plus over the weekend, following the planned hikes later in the year, it will put that on pause. And this is coming as it tries to assess as well its market share. So something we're watching in the session, maybe that is also influencing some energy-related stocks in the region. Take a look at what we're seeing in bonds in Australia and in New Zealand as well. Of course, tomorrow we do have an RBA decision where it is not not expected to change on rates, but of course it's about the overall trajectory against a really hot inflation backdrop. In a few minutes, we begin our coverage from Hong Kong FinTech Week. The city's Secretary for Financial Services and the Treasury, Christopher Hui, joins us. All that and more. Keep it here with us. This is Bloomberg.
This is the Asia Trade. We're counting down to Asia's major market opens. Japan away on holidays, but we're watching a couple of rate decisions from Australia, Malaysia this week. Avril, we don't have a lot of direction coming from the U.S. given that the government is shut down for a fifth consecutive week already. We do get usually payrolls numbers, so those jobs numbers will not be in focus this week. We'll be watching some central bank speakers, including Central Bank of Europe, ECB's Lagarde, not to mention the Fed's Daly and Williams as well.
Yeah, Fed speak, and then perhaps investors also focusing more on the private data as well for the moment. Let's take a look at how markets are opening in Korea.
Yeah, because Japan away on holidays, as I said earlier, but Korea, of course, has been on a tear. We're talking about 68% gains already year to date. And we are still digesting the results out of the APEC summits, including the finalized trade deal with the United States. Of course, we have seen a lot of optimism when it came to those car makers. We're also getting a little bit of optimism when it comes to entertainment stocks, given that China and South Korea have held those summit talks and they discussed cultural exchanges. Take a look at the Kospi gaining 0.5% early in the market session. And we're looking at the Korean won strengthening a little bit. 14.28 is the level. But of course, it's really been the focus on semiconductors, on those tech exports, because we saw exports rebounding in the month of October. And it was really semiconductors that was driving those gains up more than 20%, Avril.
Yeah, we're also keeping tabs on commodities. Brent is ticking higher. Gold is going the other direction. We are hearing from OPEC Plus. It plans to perhaps pause on these output hikes for the first quarter of next year. But then when it comes to gold as a driver, keep in mind how China is ending those tax breaks. Does that affect the retail buying in any way? Keeping watch on some of the gold-related stocks in the session as well. But as we've been highlighting, the Fed speak, that has been quite divergent. Take a listen.
I eventually got behind it. You know, I've been on record for most of this year that I thought that one cut would be appropriate as we tried to figure out how the economy is working. You know, we have our mandates, their intention. There's weakness in the employment side, but there's also, you know, we have not been at target for almost 5 years on the inflation side. And so figuring out which one is the most significant, I think, is important. I was able to get behind it because it's more than where I was, because I still think we're in restrictive territory.
I would have preferred to have held rates steady at this meeting and not have to reduce rates. As Raphael says, it's a challenging time for monetary policy. We're being challenged on both sides of the mandate. You know, we have inflation that is too high. It's about a percentage point above our target and has been there for a long period of time. My projection is that it's going to stay there probably for the better part of next year before it starts making its way back down to 2%. And on the other side, we've seen some emerging signs of softness in the labor market that we need to be attentive to.
So as we pass the Fed speak, let's bring in Bloomberg M9 strategist Mark Cranfield. Mark, we are hearing them talking about how they're kind of torn between both sides of their mandate, but also that overhang on Fed independence. What is the path to least resistance for the Fed and for markets?
Especially difficult when there's a shutdown and a lack of data, as they were talking about just then. So traders are going to be in for a pretty bumpy week, I think, in terms of the Treasury market, because last week Jerome Powell was a little bit more hawkish than people expected, pushed back a fair bit on the idea of a rate cut in December. It's not going to be a certainty by any means in his mind. And yet there'll be several people within the Federal Reserve who don't agree with him clearly on that. And you're going to hear some of that this week. At the same time, they're being challenged by the fact that they've been missing a lot of data. We're going to miss another jobs number by the look of it. They do have one CPI report in their pocket. There probably will be another one. But we're likely also to hear a lot more pressure for the shutdown to end, because neither party would want this to go into Thanksgiving. We're already into November. It will become very dangerous for the political situation if it's still going on through the Thanksgiving holiday. So we're probably going to hear a lot more about that. That will also affect what happens with Treasury. There's some volatility there as well. So we're likely to see the yield curve whipping around quite a bit this week. But at the same time, probably maintaining the idea that there are still more interest rate cuts to come, and they'll go into next year. But in terms of the December meeting, it certainly is beginning to look like a coin toss now, and that will affect the short end of the curve, probably more than the long end.
Mark, and yet when it comes to the stock market, what matters more, the Federal Reserve or just this incredible AI rally?
Oh, for now, the AI theme is the dominant factor around the world, not just for US equity markets. It's the biggest theme that we're dealing with on a global basis as well. And for the time being, I don't think anyone's quite ready to fully give up on that. Whether we have changes 25 basis points here or there from the Federal Reserve, in the big picture of things, that's relatively small when you see the kind of size of movements we're having in the equity markets and the kind of profitability which these major companies are putting through. We saw some huge numbers last week from the big American companies. We've seen it also from the major companies in Asia as well. Samsung, SK Hynix, TSMC, all producing tremendous profitability. And we've got Tencent and Alibaba to come along with the other big Chinese names in the next couple of weeks. It's likely to keep the ball rolling in that direction. People don't want to be left out. They see the chance for some very quick and substantial gains in the stock market, and people don't want to call the top during that situation, even though they may think there's a bit of a bubble going on. Who wants to be the person that calls it too early when it could go on for several months? So by far, the AI theme is a much bigger story than anything else going on at the moment, until you see some serious pushback. You've had the CEOs of the major companies, including Jensen, Huang, saying he's not worried about it just yet. He sees plenty of order books going into 2026 as well. So for the time being, investors will probably go with that. At some stage, they're going to be a bit more cautious, but that is probably a story for early next year, not for 2025.
Speaking of pushback, we're getting verbal intervention recently on the yen. We're approaching 155 on dollar yen. How much top are you expecting with Japan market shut today, and how might that shape what we see in the week ahead?
Just because it's a public holiday in Japan, it doesn't stop them from speaking about the market. We've seen it before. It can happen, particularly if it moves too quickly. Dollar yen's already a little bit higher in early trading today. Probably hasn't moved quite enough for them to get excited about it, but if it carries on during the day, we would expect to hear from some Japanese officials. The big issue, and last week again made it clear, is that the Ministry of Finance in Japan and the Bank of Japan need to clearly be on the same side of the story here. They both need to get aggressive in terms of showing that they really want a stronger currency, and that has not been the case so far. So traders, no wonder the Ministry of Finance called it a one-sided move, because that's basically what it is. So for the moment, foreign exchange traders don't really fear that the Japanese authorities want to support their currency until they see the Bank of Japan serious about hiking, and not just hiking interest rates, getting them to a neutral level, which is probably at least 50 basis points higher than where they are today. Until they're convinced that the Bank of Japan is going to do that, the yen will probably be an underperforming currency for quite a while.
And Life Strategist Mark Cranfield there with the latest on the markets, as we're watching some sectors across South Korea and Australia, especially when it comes to rare earths. Of course, we briefly mentioned the trade negotiations that happened on the sidelines of the APEC summit, and the U.S. and China now agreeing on that trade deal, with Beijing effectively suspending implementation of additional export controls on rare earth metals. They have also agreed to terminate investigations targeting U.S. companies in the semiconductor supply chain. So we've heard from the White House confirming these details, and you can see right there those rare earth stocks gaining ground early in the Asian session. But we've also heard from the Treasury Secretary Scott Bessent cautioning that allies still need to be wary. Take a listen to what he had to say.
The Chinese have cornered the market, and unfortunately, at times, they prove to be unreliable partners. I think, and I hope, after the agreement and the goodwill between President Xi and President Trump in Korea, that we can depend on them to be more reliable partners, and the rest of the world can depend on them. But, we can't take that chance. We don't want to decouple with China, but we're going to have to de-risk.
Let's bring in our China correspondent, Min Lo, joining us from Hong Kong. Min, we're getting some more details on what the U.S. and China have agreed to. What do we know at this point?
Yes, Shery, the White House has released a fact sheet detailing what exactly has been agreed upon. And this is all according to the U.S. for now, because the Chinese side hasn't really released their version of the statement. But according to the U.S., China has agreed to suspend those export controls, a very sweeping measure, because it not only undo some of the measures that were announced and imposed in October this year, but also the measures announced in April this year and in October of 2022, and this means that general licenses will be granted for rare earths, for gallium, germanium, antimony, and graphite. It's an important win for the U.S., which says that this is a massive victory for U.S. national security. But here on the screen, you can see that China also agreed to stem the flow of fentanyl into the U.S., and in exchange, the U.S. will lower the fentanyl-related tariffs by 10%. China is agreeing to buy soybeans, 12 million metric tons this year and 25 million metric tons for the next 3 years. China also agreed to end investigations, anti-dumping investigations into U.S. chips companies, the likes of Qualcomm, Nvidia, for example, and also suspending those countermeasures, including tariff and non-tariff measures since March 4, which means that those tariffs on U.S. agricultural goods will be lifted as well. Now, in exchange, what do they get in return? The U.S. is suspending the 100% tariff, the threat of those tariffs that they had mentioned earlier. They're going to extend the current tariff truce. They're suspending or rolling back the expansion of the rules regarding the entity list that had been expanded to cover the affiliates of those companies on the list. But now that's going to be to be reversed for another year. What's not been discussed is the TikTok deal. The U.S. has a plan to divest that, but so far China has yet to formally approve. And of course, Taiwan and Ukraine not really discussed in that trade talk as well.
Yeah, when it comes to the U.S. and China, to your point, it's not just about trade. It's also in relation to defense or security priorities. And we're hearing how the Chinese and the U.S. have agreed to set up a direct military communication line. How significant is this?
Yes, this was the latest development over the weekend when Pik Hegseth, the defense secretary, was in Kuala Lumpur for the ASEAN Defense Ministers Summit. So he met with Dong Jun, the Chinese defense minister, for the first time. And both sides agreed to establish military-to-military communication. This is an important move, right? After the 2022 incident when Nancy Pelosi visited Taiwan, those military communications had been disrupted. There had been efforts to restore them, but it's been largely dormant over the last few years. And it's important, but also coming at a time when Pete Hegseth was in Kuala Lumpur to meet with his Southeast Asian counterparts, calling on them to expand maritime cooperation with the U.S. in an effort to counter what he sees as growing Chinese assertion in the South China Sea. So this is something that will continue to anger China. And as one Chinese military commentator had said, even as both sides establish military communication, it doesn't mean that mutual trust has been achieved, and we still have to monitor what happens moving forward, especially given that after the trip to South Korea as well, Korea also had gained approval from the U.S. to build nuclear-powered submarine in Philadelphia. And of course, there is going to be concern about how those submarines are going to be used in the Indo-Pacific.
I mean, another bilateral that we're watching were between Presidents Xi Jinping and Lee Jae-myung at the APEC summit. The first face-to-face meeting since Lee Jae-myung came to power. Anything significant that came out of it?
Yeah, it's a very important meeting considering that this is the first time President Xi has visited South Korea in 11 years. And it seems like there is a normalization of ties going on, at least according to President Lee Jae-myung's office. President Xi saying that he's willing to deepen cooperation with South Korea. According to local media reports, both sides discussed the expansion of cultural ties. And a South Korean lawmaker said that President Xi appeared to be quite open to the idea of hosting a South Korean K-pop concert in Beijing, even calling on Foreign Minister Wang to follow up on it. But the South Korea ministry, official statement from the government saying that this is just courtesy comments at a diplomatic event, so don't read too much into it. But still, a pretty positive event so far, especially considering some of the visuals coming out of the event. We saw President Xi and Lee Jae-myung sharing a very light-hearted moment when President Xi offered 2 Xiaomi iPhones to South Korea as a gift, and President Lee said, kind of jokingly asked whether there was any, security concerns around using these phones, and President Xi asked him to check for any security backdoor, and the two men were seen laughing at the joke.
Bloomberg's China correspondent Mimi Lo there with that warming up of relations between China and South Korea. These are some of the Korean entertainment stocks that we're watching on those cultural exchange optimism. We have seen, of course, China's informal ban on Korean entertainment for now a decade. Remember, K-pop concerts, TV dramas, films, they've been effectively banned since South Korea's decision to deploy the U.S. THAAD missile defense system, which Beijing views as a security threat. Since then, with the warming up of ties, there's been a lot of expectation that perhaps that effective ban would be lifted. That's not happened so far, but you can see right now some of those entertainment stocks gaining ground. More ahead. This is Bloomberg.
Let's take a look at how Asia stocks are faring in the early goings. About 17 minutes into the Korea session, and that is the outperformance you're seeing on the benchmark. Some of the sectors we're watching include the K-pop or entertainment-related stocks amid a warming of relations between the Chinese and Koreans. But of course, tracking as well the earnings-related scorecard of the likes of Westpac. We are seeing some pressure coming on lenders overall in Australia, and the benchmark there is down just a touch. S&P 500 futures pointing to that upside. Meantime, Hong Kong's FinTech week set to begin today, bringing together banking executives, founders, VCs, regulators. Let's get to our tech correspondent, Annabelle Jolas, who's standing by with our next guest. Belle?
Thanks, Avril. Yeah, I'm joined this morning by the Hong Kong Secretary for Financial Services and the Treasury, Christopher Hui, joining us. Well, thanks very much for your time, and great to see you again. I think we can start with the overall event, because we were just saying that this is the 10th anniversary of the FinTech Week in Hong Kong. But what's the main message that you're going to be bringing to people that are going to be attending today?
I think, first of all, in terms of the scale and in terms of participation, it has been very overwhelming. And right now, we have more than 600 exhibitors and also more than 500 speakers all across the world, and also at the same time with more than 20,000 tickets sold. So with our 10th anniversary of FinTech Week, what you see is that the momentum is really strong. And also back to your point about the 10th anniversary, if you look back like 10 years ago, we only have around like 1,600 startups. Now we have almost like 5,000 startups. And also at the same time, in particular for FinTech related startups, we have more than 12,000, so 1,200. So you can see that this is really a landscape which is rapidly evolving. And in particular, Hong Kong is come to a stage where we have put together a lot of policy statements in terms of how we view digital assets, responsible AI, and also concerning fixed income and currency markets. So all these pave the way for a very solid foundation for the continuous growth of our financial service sector.
One of the areas that's been most interesting on the regulation side this year has also been that promise around stablecoins. But on that stablecoin progress, we've heard at the same time about China telling some of its brokers, for instance, to stop touting stablecoins to try and cool that rush. Off the back of that, have you heard of any stablecoin companies or applicants pulling out?
If you look at the overall policy framework that we put together for our digital asset, basically what we say is the LEAP framework, including like a legal and regulatory streamlining, and that refers to legislation you mentioned, and also about the E is on the expansion product suites, in particular tokenized products, and for A is about advancing the use cases, and the P is about partnership and also people development. And back to the point about the legislation that we've already put in place. Right now, we already have around 11 regulated digital asset exchanges operating in Hong Kong and regulated by us. At the same time, as you said, the stablecoin legislation has already been effective, and we are now assessing the application, and we will issue the licenses soon next year.
On that point, though, around regulation and what's coming ahead, you've just recently also returned from Beijing and Hebei at the end of October. You had some meetings there, including with the top official that's overseeing Hong Kong as well. What was the main message that you received on the outlook for Hong Kong, not just in terms of digital assets, but also the broader financial landscape?
For our trip to Beijing and also to Hebei, basically we went to places. One is Tongzhou, which is like the administrative capital of Beijing, where they moved many of the Beijing-related government entities over there in such a way that they can leave more room right now in the capital for other uses, especially for those central government agencies. And another place that we went to is Hebei, which is about Xiong'an, which is a place where they move many of the SOEs right now in Beijing to there as well. And I think what we see, first of all, is that very much the ambition and also the vision of the government to lead these developments. And at the same time, it is very well planned and also well articulated in terms of what they plan to do and what they have set out to do. So I think all these will have particular relevance to our current plan to develop our northern metropolis, because it's similar to what they are doing. We are going to develop a new piece of land, which is 1/3 of South Hong Kong, and at the same time it requires planning and also at the same time collaboration, not just with the public sector, but also the private sector. And this is exactly the major observations that I had during the trip.
What about the process around IPO reform as well? Has there been any talk of that? Plans to ease rules for Chinese companies that are looking to have dual listings, both in New York but also Hong Kong?
Right now, we will have a rather strong pipeline for our IPOs. Our stock exchange is processing around 300 of them in terms of IPO applications. And so far this year, we have already around 70 new listings and having an IPO proceeds of around 180 billion Hong Kong dollars. So what we can see is that it's a very sustained momentum, and at the same time underpinned by a very strong pipeline, and we will expect this to continue.
This is a big week for summits in Hong Kong. There's a lot of different events that are taking place. What is one thing that you think is going to be different this week compared to what you've seen in years past? And what is as well the biggest risk that you see to Hong Kong's resurgence?
I think there are two words I will emphasize. For fintech, it's about implementation, because Hong Kong is a very pragmatic place. At the same time, when we try to regulate the market, we have to make sure that we have regulation. At the same time, we are taking a facilitating role towards market development. That's why across the FinTech Week, for example, you see many use cases and many scenarios where you have actual implementation of FinTech solutions. So implementation is the key. And another thing is about fundamentals, because what you see is that so far with the upsurge of our stock market, as you highlighted, at the same time with the strong pipeline that we have on the IPO, it's not just a momentous development. Rather, it's underpinned by strong fundamentals, including one country, two systems, the strong economy in this part of the world. At the same time, the regulatory and also market changes that we've introduced over the past few years in our stock market and capital market. So we expect this to continue.
All right, Christopher, you're going to be very busy this week, I think. That was Christopher Hui there, the Hong Kong Secretary for Financial Services and the Treasury. But Shery, I'll pass it back to you.
Yeah, Annabelle Jewelers there joining us from our Hong Kong FinTech Week coverage throughout the week. And we do have many conversations coming up, exclusive interviews with Primavera Capital on the China Show, and Qiming Venture Partners will be joining Insight with Hazinda Amin. We have more ahead on the Asia Trade. This is Bloomberg. The top corporate stories we're tracking: Berkshire Hathaway's cash pile surged to a record $382 billion in the latest quarter, as earnings also jumped at Warren Buffett's conglomerate. The firm's cash hoard grew as Buffett avoided deals during the quarter. Insurance underwriting profit more than tripled. Berkshire declined to buy back shares for a fifth straight quarter. The stock has tumbled almost 12% since Buffett said in May he would step down. Australian lender Westpac reported profit in line with estimates thanks to growth in mortgages and loans to businesses. CEO Anthony Miller has worked to overhaul the lender since taking over in December, reshuffling senior management and cutting jobs to reduce costs. Westpac also sold its Rams mortgage portfolio to a group including KKR, a move Miller says further simplifies the bank. Still to come, New Zealand Prime Minister Christopher Luxon on the challenges of a changing global trade order. That interview coming up next. This is Bloomberg.
Some breaking news crossing the terminal. We are shining the spotlight on New World. This is, of course, the troubled Hong Kong property developer that has been beset with financial difficulties, partially due to the downturn in the property market. And we are since hearing that on top of this launch of exchange offers, it will issue up to $1.9 billion in new securities and notes. And it is endeavoring to further improve its overall financial position. Of course, we know how its exchange offers commenced today, and part of the intentions behind this is to optimize the company's debt maturity profile. So once again, we know how it is issuing up to $1.9 billion in new securities, and the optimism behind this is that it will help to enhance balance sheet flexibility and liquidity as well. This is according to an HKEX filing, and it'll also result in an aggregate principal amount of new perpetual securities and new notes being issued that is no greater than that $1.9 billion. That's what we know for now. Shery?
Avril, and take a look at some breaking numbers across Asia right now. PMIs for the month of October coming in. The likes of Australia manufacturing PMI falling to the lowest since December of 2024 on a week when, of course, we are expecting the RBA to decide on policy. The expectation is to keep rates steady at 3.6%. You can also see right there, Indonesian October manufacturing PMI has improved to over 51. Vietnamese PMI rising to the highest since July 2024, and also Thai manufacturing PMI numbers rising to the highest since 2023 as well. What we have coming up is the Chinese private manufacturing PMI that we'll be watching as well after those official numbers showed weaker than expected data. Let's turn to New Zealand. Prime Minister Christopher Luxon says his country remains committed to reaffirming ties with allies amid rising risks to the global trading order. He spoke to us on the sidelines of the APEC Leaders Summit in Gyeongju, South Korea.
I think there's three big shifts that are happening. We're seeing a shift from sort of rules to power. We're seeing very much a strong connection between economics and security. And the third thing we're seeing is a lot more national resilience rather than globally connected supply chains. And that's a function of COVID, it's a function of our economics, a function of a changed trading environment. So there's no doubt about it, the rules-based system that has served us well for 70 to 80 years is challenged. But within that context, we should be incredibly optimistic that we can plot a course and that we can innovate and that we can incubate new ideas as we have done in the past out of APEC. And so whether it's been the FITP, whether it's been the thing that both Mark and I have advocated very strongly for and talked to the Europeans about, is to have an EU CPTPP dialogue, a trade dialogue, so that we can reaffirm the rules-based system. Those are important things. But equally, we should be reforming the WTO. We should be doing a bunch of things to make sure that we are relevant and on point and able to deal with the world as it is today.
And Mark Carney's strategy is to pivot to Asia from the US because the US is a much less reliable trading partner for Canada than it has been in the past. New Zealand's obviously very, very dependent already on trade with Asia. Do you have a similar strategy of sort of trying to improve and increase New Zealand's?
Our strategy is pretty simple. As a small trading nation, as we want to do business with as many people as possible and as many places as possible. And so our real focus as a new government has been an Indo-Pacific reset and focus. We see that's where our security sits, that's where our prosperity will sit. That's why we've had over 42 visits, I think, into Southeast Asia alone as a government. But we spent a lot of time in China, in Southeast Asia, in Northeast Asia, expanding our FTA, negotiations with India, obviously closing out negotiations with GCC and the UAE, building back a strong relationship with Australia and having and playing a role in the Pacific. So, for us, our Indo-Pacific region is both where prosperity and security sits, and both those two things in 2025 are inextricably linked. You can't have one without the other. They are mutually dependent on each other.
And on the domestic economy, the economy contracted in the second quarter after a number of consecutive contractions. Reserve Bank cut rates in October, but Nicola Willis was telling us last month that she's confident the economy is growing this quarter. Are you as confident at the start of November that the economy will return to growth in the fourth quarter? Are rates where they need to be accommodative enough for New Zealand, and what can you do on the fiscal side to help the economy sort of return to growth?
Yeah, look, we're coming out of a recession that's been our biggest recession, I think, in 35 years. New Zealand also had probably one of the longest COVID hangovers. We were the second biggest proportionately spending economy. The previous administration, was a big spending government, taxing more, borrowing more, spending more. Our job is to put the fiscal repair and consolidation in place, and that's what we've been doing. And so I think as fiscal partners, getting control of spending so that we can get inflation down, get interest rates down, get the economy growing, and lower unemployment is a good thing. And we're well on that pathway. We had good growth in Q4, good growth in Q1. Obviously, the second day of April with Liberation Day, that meant a huge loss of confidence to investors and also to consumers. But we're growing again in the third quarter and expected to accelerate in the fourth quarter. The outlook for New Zealand is very positive. I mean, we are expected to grow 240,000 new jobs in the next 4 years, average probably 2.7% growth, I think 2.4 over the next 2 years as well. So, the outlook is there, but the question now is we don't just want to watch a recovery take place, we want to shape that recovery. And that means for us, we've got a fantastic future, we've got a great country, and we need to make sure it realises all of its potential, and that's what my government's very focused on.
So the Reserve Bank said at the meeting, or the governor said that the economy is still weak and they were looking to cut further. You probably won't comment. If you're happy to comment on where the policy rate should be, I'd love to hear that. But I mean, do you agree with that?
Well, I respect the independence of our Reserve Bank of New Zealand, but they've already forecasted that they've got one more opportunity potentially to cut rates further before Christmas. And again, what you need is fiscal and monetary policy working in concert together. And so we're doing everything we can as a government to make sure that we're getting rid of the wasteful spending, that we're actually doing our role, so that coupled with monetary policy, we can actually lower inflation, lower interest rates.
New Zealand Prime Minister Christopher Luxon speaking with Bloomberg's James Mager. Some other top global headlines we're following. President Trump has threatened possible U.S. military action against Islamist militants in Nigeria unless the country's government halts the killing of Christians. Trump designated Nigeria as a country of particular concern and in a Truth Social post also threatened an immediate cutoff of aid. Nigerian President Bola Ahmed Tinubu rejected Trump's claims that his country is religiously intolerant. Energy Secretary Chris Wright says the U.S. nuclear weapons testing ordered by President Trump will stop short of actual warhead tests for now. Wright told Fox News he believes what is being discussed are systems tests involving other parts of the weapon and without nuclear explosions. Trump said last week he's ordering the Pentagon to start testing nuclear weapons in response to other nations' programs. U.S. Defense Secretary Pete Hegseth has called on Southeast Asian nations to strengthen cooperation and counter Chinese aggression in the South China Sea. Speaking at a meeting of ASEAN defense ministers in Malaysia, Hegseth urged the group to develop joint capabilities to address threats. He also raised concerns about China's naval activity around Taiwan during a meeting with his Chinese counterpart, Dong Jun.
China's behavior toward its neighbors and the world is a wake-up call, which it is. shared examples of intimidation, harassment, and illegal activities occurring within your sovereign waters and across the South China Sea. Unfortunately, in the months since then, China's destabilizing actions have only increased.
China has criticized Japanese Prime Minister Sanae Takaichi for meeting with Taiwanese officials on the sidelines of the APEC summit in South Korea. Takaichi posted on X about her dialogue with Taiwan's presidential advisor last week and said she looks forward to deepening cooperation with Taipei. China, for its part, called Takaichi's actions egregious and accused her of hyping the meeting on social media. We have more ahead on the Asia trade. This is Bloomberg.
No, not at all. It's clear that we have a meeting-by-meeting approach. We know that the uncertainty is high. It depends a bit on the shift of risks, but also, of course, whether some of the risks that we all know about in world trade, in geopolitics, but also in economics, in financial market stability, whether they manifest themselves or not. And I think given an unusually high level of uncertainty that we have been experiencing over a couple of years now, and still having, it is good to have this data-dependent approach.
ECB Governing Council member Martin Kosher speaking after the ECB decision to keep rates steady. Take a look at how assets are setting up in Europe. We have seen the euro decline to the lowest level since August. We had data showing that euro area inflation eased slightly. This week, we also have the Bank of England's rate decision. But one story that we're following in the European Union is the bloc considering a new trade measure that would require some Chinese exporters to supply critical raw materials to the EU when they're shipping certain goods into the market. The EU seeking a solution that will provide its importers with a steady flow of supplies and greater certainty when it comes to those critical metals, Avril.
Yeah, and you also wonder whether what's happening between the EU and China adds to this sign of dialing back of geopolitical tensions globally overall. After what we saw between the US and China in the past week, gold continues moving away from the 4K handle, but we are seeing an uptick in the other commodity, of course. We're talking about oil prices, Brent crude moving up a touch after OPEC Plus agreed to pause output hikes next quarter. Let's get more on the crude outlook with Steven Stepczynski, who leads our Asia energy coverage. So, Steve, this came as a bit of a surprise to some, perhaps, in terms of OPEC Plus pausing these output hikes in the first quarter of next year. How significant is this move?
Yeah, I think the way it came out, right, the first quarter pause maybe surprised some. But, I was speaking with oil traders even over the weekend, and they were saying that with what's happening, the pressure against Russia, right, the U.S. sanctioning Lukoil as well as Rosneft, that effort really constrains their amount of oil that they can bring into the market. And because of that, they were expecting that at this OPEC Plus meeting, Russia would again be sort of fighting or pushing for some sort of pause. Now, they did move forward with the 137,000 barrel a day increase for December. That's a continuation of what we've seen over the last few months. It's a modest increase. But yes, the pause for the first quarter does indicate a few things. So one, you can say this is what Russia has been pushing for. Maybe this is a capitulation to them or something that they're able to get out of it. The second thing is the market is shifting into an oversupply, especially when you look at China, specifically in Chinese buying. China was able to soak up a lot of this output that the market had been increasing, not just in OPEC Plus, but also in the United States. U.S. output has been very strong. they were stockpiling all that supply. Now their ability to do that is probably going to be slowing because their stockpiles are full. So that's one more factor. And then the last thing, of course, is just how much can OPEC Plus actually increase output. A lot of countries have been struggling to hit their targets, increasing supply. So this pause gives them a little bit of time to recalibrate so that they can check the situation in the market. But certainly this is a factor that is helpful for the bulls, especially since the oil market is specifically looking into an oversupply going into 2026.
Stephen, give us a little bit more on that supply-demand picture that you're talking about, because last week when I spoke to the Continental Resources Chair, Harold Hamm, he was talking about how, yes, there is an oversupply, but we're going to quickly run through all of that in just a few months, and that we are going to see actual demand spiking up. So what are investors and also analysts thinking about the price of oil going forward in the next year?
Harold Hamm is a legend and a maverick in the industry. I think his view might be a little bit separated from what the analysts are saying. You know, when you look at what the IEA says or even what the banks are saying, you're looking at for this next quarter millions of barrels of oversupply for the fourth quarter globally, according to the IEA. I think the supply-demand picture is one that does point to a bearish sort of outlook when you see the research and when you do see the numbers coming through. So U.S. output has remained quite resilient despite the lower prices. You would have thought that producers would be taking their foot off the gas. You would think that the rigs would be coming down, but instead it seems that U.S. producers are actually becoming more efficient and more cost-effective with their barrels. At the same time, you have to look at China. Chinese demand hasn't really materialized to the way that maybe people were hoping over the last year. Their buying has been quite strong, but that's mostly because of stockpiling. And then you have, of course, the OPEC Plus is still adding more barrels into the end of the year. I think a big question is how does the trade tension globally affect demand? How does it affect economies? And where does that bring the oil demand picture going forward?
Steve, always fantastic. Thank you so much. Steven Stepczynski, who leads our Asia energy coverage. Now, Steve was just talking about China. Gold, of course, is in focus today after China over the weekend scrapped its long-standing gold tax incentive. And it's seen as a potential setback for consumers in one of the world's top bullion markets. Let's get more from Asia Metals and Mining reporter Sibylla Gross. Sibylla, talk to us about the extent in which the scrapping of the tax break by China is going to influence metals prices, or the precious metal price more specifically.
Good morning. Yeah, I mean, it was quite a surprising announcement, really. I don't think it was expected. It is a bit of a developing story. I think there's a bit of uncertainty as to, what the new levels actually are. But the fact that, China is the biggest consumer of bullion, this is definitely quite a bearish sentiment. The news story we're seeing this morning, despite the fact that, the breakneck run that we've seen in prices over the last month, was really largely driven by Western investors and less China. But the fact that, we're potentially getting rid of this large tax break that retailers normally enjoy when buying from the Shanghai Gold Exchange or Shanghai Futures Exchange, the fact that that's no longer there's a little bit of uncertainty of what the levels are, but it does seem to be quite a bearish development.
What's the outlook from here? Because after we saw that incredible rally in gold prices, with the Fed outlook also easing when it comes to potential rate cuts.
Yeah, I mean, look, we have seen quite a few other bearish developments. We had a hawkish cut out of the Fed last week. Some questions here about whether we're actually seeing an improvement in US-China relations with the trade truce struck last week. Despite all that, I think, a lot of analysts do see this correction as quite a healthy one. If you're looking at the bigger context here as well, despite, one day where we had the biggest decline in more than a decade. Where prices are sitting currently is, we only reached these levels about a month ago. So a lot of people are seeing the correction as quite healthy. And a lot of the fundamentals that help underpin and support gold, such as central bank buying, are still there. The World Gold Council came out with a report on Thursday, and they said central bank demand had picked up in the third quarter, and they do expect higher than usual levels of buying. And, some of my colleagues were at a big precious metals conference in Kyoto last week, the biggest one of the year. And every year they do a poll asking everyone there what they think the gold price will be next year, so October next year. And, they all predicted that levels will be close to 5,000. So I think the fundamental drivers are still there.
Asia Metals Omanian reporter Sibylla Gross there. Thank you. We have more ahead on the Asia trade. This is Bloomberg. Take a look at the incredible rally that we've seen around AI-related stocks. The S&P 500 has gained about 18% since President Trump became president and took office. But if you take away the mega caps, we're only talking about 5% gains for the S&P 500. So you can see how important these AI-related stocks have been, especially with the rally on Nvidia, the first ever $5 trillion company. And this is really in a matter of months, right? It went from $4 trillion to $5 trillion in just 4 months or so. I actually spoke to Jensen Huang last week on the sidelines of the APEC summit and congratulated him on this win, but also at the same time, I asked him if this reflected fundamentals, especially given that Nvidia remains effectively shut out of the Chinese market. Take a listen. Congratulations on becoming the first ever $5 trillion company, given the exuberance of our artificial intelligence. But as a CEO of the company, does that give you a little bit of pause, or do you think that reflects fundamentals? And how big of a risk is it that you're still shut out of the Chinese market?
Well, it took 30 years for us to do this, and we have invented a new computing approach. As you know, the computer has remained largely the same for 60 years since the invention of the IBM Systems 360. And after 60 years, we reinvented the computer. And now we're going through these platform shifts, and AI is the most impactful technology that anyone has ever known. It is fundamentally about generating intelligence. The impact is quite extraordinary to every single industry. So I'm proud of the fact that we've reinvented computing. I'm proud of the fact that we're part of a technology revolution that is impacting every field of science and every industry. And it will be impactful for every single country, including Korea, which is the reason why we're here and why President Lee and all of my CEO friends and companies, the giant companies here in Korea, have announced big partnerships, and we're going to launch new AI infrastructure into Korea. So I'm quite pleased about that, and I'm proud of the fact that Nvidia is at the epicenter of all that.
What's the potential of sovereign programs that you mentioned, especially across Asia?
Well, here in Korea, Korea has a chance to be one of the world's major AI hubs. And today's announcement, along with President Lee's passion and enthusiasm and drive, and all of my CEO friends here who are dedicated to create this journey for Korea, this is a perfect example of sovereign AI.
We just saw you have a conversation with SK Group's Che Tae-won. SK Group and Samsung in that rivalry right now, but you're getting business with both companies. What's the potential there?
Well, they're both friends of mine, and they're friendly competitors. Of course, competition is terrific, and Korea is going to be growing tremendously in semiconductors in the coming years. And the reason for that, as you know, Samsung and SK helped me invent the AI supercomputer. Without the HBM memory, there is no AI supercomputer. And over the next decade, memory technology and semiconductor growth here in Korea will be very significant. With respect to China, China is now 0% of our business. We used to have 95% share of the AI business in China. Now we're at 0% share. And I'm disappointed by that. And I hope that that condition will change. But irrespective, Nvidia is going to grow quite substantially over the next several years.